phone call. So this show will be live all the way through. And again, you can talk to us if you dial a phone number 604-280-0650. If you're calling long distance, 877-280-0650. You can log on, www.650radio.com. And as usual, Frida is down at the office for your convenience because there are many people out there who are too shy to talk on the air, so you can talk to Frida. Maybe you want to make an appointment for a second opinion on your investment portfolio, to get yourself a written financial plan, whatever it is. Maybe you want a review of your account. Maybe you're an existing client. You can do all that by giving Frida a call. So you can reach Frida right now down at the office, area code 604-737-3512. If you're calling long distance, it's 800-661-1495. So again, my mission is to teach people what they need to know, to educate people so that they can make better financial decisions, so that they can become financially independent sooner and stay financially independent longer. And we don't do a very good job of that, generally speaking. We go to school for a good many years of our lives to learn how to earn money, but they never teach us how to keep it. They teach us how to make it, but not how to keep it. And at the end of the day, it's not about how much you make that counts. It's about how much you keep. It's about how much you keep. And there's many, many techniques for doing that. But I think the major reason why people fail financially is called lack of a plan, lack of education, many other things. But generally speaking, lack of a plan. We have lack of knowledge, limited vision, entrenched habits. But overall, we do not have a written document called a written financial plan. And we don't have an advisor to coach us to help us make that plan work. Someone once said to me, what's the best way to get out of the hole? The best way to get out of the hole is to stop digging. Sounds pretty simple, but I have people that come to me all the time. They're spending more than they earn, and they're racking up debt. Their lines of credit increase consistently. Their credit cards have big balances, and they carry balances on the credit cards. They're paying high interest. The interest isn't tax deductible. They have a deficit, just like the, and don't feel guilty, the federal government, provincial government, the municipalities, governments around the world are running deficits. They're doing exactly the same thing. They're spending more than they earn. And ladies and gentlemen, listeners out there, give your head a shake. You can't do that. You can't do that without getting into trouble. So when you spend more than you earn, how do you cover the shortfall? Well, you got to sell something to pay off the shortfall, or you got to borrow the money. If you sell something, you lose the earnings on whatever you sell. If you borrow the money, you pay interest on whatever you sell, so the problem gets worse. It's a never-ending cycle. You're chasing your tail around in circles. You don't have a plan. So the number one thing to realize, ladies and gentlemen and listeners out there, is this. Part of everything I earn is mine to keep. I'm going to say that once again. Part of everything I earn is mine to keep, and I shall not spend 100% of what I earn anymore. I'm going to pay myself first. I'm going to make myself my oldest obligation. And I'm going to say, I'm going to look at that just like it's a debt. I have a debt to myself, and I'm going to pay myself. Every time I make $1, I'm going to save 10 cents. Not save it to spend it. I'm going to save it to keep it, so that money will grow, and someday that money will be working for me, and it will generate a second income. And that second income, at some point in the future, will become large enough to finance my lifestyle. That's what it's all about. Joining me today is Angela Price-Stevens, representing Murphy Batista.
Good morning, Fred.
Good morning, Angela. She's a lawyer. And we're going to talk to Angela about what she does and how that relates to financial planning in general. So get on the line and give us a call. And I'm just going to start off simply by saying, Angela, you're with Murphy Batista. Exactly. I mean, all lawyers don't do exactly the same thing. So what makes you special? How do you differentiate yourself from other lawyers?
Well, first of all, Fred, I do a very limited area of work. I specialize purely in medical malpractice. The other way of saying that is I spend my life suing doctors and hospitals.
So when the doctors see you coming, they run?
Well, they do if they know what I'm doing for a living. It depends what I need at the time as to whether I declare what it is that I'm doing. But no, I have nothing against doctors, and I have many friends and acquaintances who are doctors. It's only those doctors that have clearly made significant negligent errors that I'm gunning for.
Well, you know, one of the major reasons for mortgage foreclosures on houses is unemployment caused by disability, malpractice, all kinds of those issues. Like, the most important asset you have is your income. And if you lose your income for some reason because your doctor didn't do things right, that ties into your overall financial plan, doesn't it?
That's right. Even those people who are very well off, had what most people would consider a very large income before their injury, most of these people are living to their limits. And so when they're hit by an unexpected injury, or they go in for an operation thinking they'll be out in 2 days and back up and running, and of course perhaps it doesn't go to plan, and maybe they end up with quite a long-term significant disability. Most of the time these people are just like everybody else who's earning an average income or below average income, and they struggle financially. And I think the bottom line is because we all tend to spend what we earn. We all tend to live to the max, and I think that the message here is that that's really not what we should be doing. We should be almost self-insuring.
Okay, Murphy Batista, apparently you made a list here, deals with personal injury issues, medical malpractice, wrongful death, insurance claims where the insurer has unreasonably denied the claim, and preparation of wills. You don't do wills, do you?
I don't do wills. No, there are others within the firm that do wills, but I do not.
Okay, and how about insurance claims where the insurer has unreasonably denied the claim?
I have got involved with those. In fact, I do have a number on the go right now. A very interesting claim, although it is ongoing, and so I can't discuss it with any detail. But there was a gentleman who, again, a very well-off gentleman who had taken out a number of different policies, critical illness policies, and had paid faithfully into those policies for over 10 years. And then as a result of what we allege to be a delayed diagnosis of one of those listed critical illnesses, he has actually not been able, well, he's been denied the claim. He missed one payment in 10 years, and that was inadvertence, and so you can imagine the insurance company doing everything they can to avoid paying, and it would have been quite a significant payout.
Well, Angela, I see this all the time. I have people that come to me, and they have very similar situations. But let's talk to Rusty. Rusty's on the line. Rusty, welcome to the program.
Oh, good morning.
Good morning, Rusty. How you doing?
I'm okay. How are you doing?
I'm pretty good.
Okay, I just heard you talk about reverse mortgages.
Okay,
Hello?
that might have been on the show before this one,
Yeah.
which is a replay. So
Yeah,
that's quite
yeah.
possible. Yes. Okay, go ahead.
Yeah. Anyway, I enjoyed your advice in that, but could you tell me a little more about how that works?
Sure. A reverse mortgage is a way that you can pay off your existing mortgage, live in your house for as long as you live or as long as you want to, and not have to make any more payments. So what happens is that the payments just get added onto the mortgage. So your mortgage gets bigger and bigger and bigger. The people who grant that particular reverse mortgage are running the risk that the mortgage will get greater than the value of the house, but that doesn't matter. They still do it.
Well, somebody recommended a company called Chip.
They're good.
Are they good? Are they reputable?
They introduced the concept, to the best of my knowledge. I think Chip was first off the line with reverse mortgages in Canada. Like, first off, a reverse mortgage isn't for everybody. If you want to leave a legacy to your children, the reverse mortgage is eating into that legacy because the equity in the house could get smaller. It doesn't have to, because the house can appreciate faster than the size of the mortgage is growing. So you can still have equity. But you can live in that house if you live to be 200. They can't kick you out. And you never have to make a payment.
Well, so what about the old so-called small print? You know what I mean?
Well, there's nothing in the small print that I'm aware of that anybody would need to be concerned with. A reverse mortgage for some people is a very good idea. For others, it's a very bad idea.
Okay, well, if it was just my wife and I and no children, would you advise?
Well, if you have no children, listen. Who gets your money when you die?
Yeah, you're a long time dead, they say.
Who gets it? Who gets your money when you die?
Well, my wife, my spouse.
That's it, and then there's nobody else.
That's right. No.
Okay, so when your wife dies, if you died first and then your wife died, who would get it?
The government.
So you really don't care. Reverse mortgage is probably a really good thing for you.
So you would recommend calling CHIP, or would you recommend?
Well, I would recommend, first off, and this is for everybody's benefit. If you're listening to this show and you just heard what we're talking about, don't go to CHIP first. Come see me first. Get yourself a written financial plan. Don't just run out and do anything that we talk about on this show without getting overall financial advice.
Oh yeah, no, I wouldn't do that. But what is the cost of your service then? Could you?
I don't charge for financial advice. Not at all.
Okay, so if I called you at Frida's number tomorrow or sometime,
yes,
I can set up an appointment.
You just call Frida, set up an appointment, come on in, and we'll talk about it. They'll give you all the pros and cons. They'll give you a written report on it. Okay, in fact, when things like this come up, what I'm in the habit of doing right now, I do a newsletter. I think I'm going to do a newsletter on reverse mortgages.
Oh, okay. Well, do I get any commission on that?
Commission is how I get paid. So if I place a reverse mortgage for you with CHIP, I will get paid a commission.
Oh, okay. Well, it's just
that's how I'm compensated.
Oh, okay. Well, how about I'll call Frida back, and then maybe I'll hook up this week or something.
Okay. Well, that would be super. And when you come in, I will sit down with you, and I will do an inventory of your income, your assets, your income, your expenses. Any insurance policies you have, whether you have a will or not, the whole 9 yards, I'll do that, and there'll be no cost of any kind for me to do that. And again, that's for everybody's benefit. You're listening to the show, you're out there, you're saying, well, I don't want to go there, it's going to cost me a lot of money or something. Doesn't cost at all.
Okay, well, that sounds pretty fair to me.
It is. Well, Rusty, I can't tell you how much I appreciate your call.
Okay, well, thank you very much.
You enjoy the rest of the weekend.
You too. Bye.
Bye-bye. Okay, Rusty's line is now open, so if you've just tuned in, I'm certified financial planner Fred Snyder, also a registered financial planner representing Scotia McLeod. And again, we're talking about your money, but more importantly, about your money and how to keep it. That's really what the bottom line is. And again, the last number of shows we did, we talked a lot about the 13 reasons, the 13 major stumbling blocks, 13 roadblocks that people have to overcome to become financially successful. 13 reasons why we fail financially, and I have a brochure. Anybody who calls the show will get this brochure, so just give us a call, and we'll refer that to Frida, and we go from there. So again, bottom line is that everybody needs a financial plan, everybody needs a financial planner, and everybody needs the best financial products inside their plan. So we're talking about the legal side of financial planning here today. And there is a legal side to it, because embedded in a financial plan is your estate plan. There's a lot of legal issues in there. You have trusts. You have alter ego trusts. You have inter vivos trusts. You have the trust. What do you call the trust after you die? What's the name of it? The name escapes me right now. But can't grab it. Must be getting too old.
I'm just reviewing this brochure as you're talking, and it's excellent, I have to say. You've covered everything.
Anyway, the testamentary trust was the word I was looking for. Okay, so That trust is the one that exists after you've gone. Okay, that's the bottom line. So every will has a testamentary trust built into it. We have the Wills Variation Act in BC. We have all kinds of legal issues. And as a financial advisor, my main job is to surround myself with a team of experts. And I consider Angela to be an expert in her particular field. Okay, so if you have any questions, legal or otherwise, any questions regarding your money, get on the line and give us a call. In the meantime, we'll talk to Alan from Vancouver. Alan, welcome to the program.
Yeah, it's a great day, and thanks for taking my call.
No problem, Alan.
I have an observation, then I have a question.
Sure.
My observation, I guess everybody knows, the interruption in the educational system.
Mm-hmm.
And I'm not speaking about the school system. I'm talking about your workshop. I miss it. And I hope you pay the penalty of not taking your fishing trip.
Okay.
You can't just cut off education and.
If I get enough, well, put it this way: if I get enough callers calling in right now, maybe I'll re-implement my my workshops.
Yeah, if you go fishing, you have a good time. Now, my question.
Yes, Alan.
Could you explain the difference between and the merits and demerits between a mortgage debt insurance and mortgage insurance?
Oh, that's a really, really good question. And there really isn't a big difference. They're both forms of life insurance.
Yes.
The way the terms are used, mortgage insurance is a life insurance policy, and it's called decreasing term.
Right.
Let's say that you have a 20-year mortgage. You can buy a decreasing 20-year term policy where the death benefit of the policy decreases a little bit each year as your mortgage decreases and runs out at the end of 20 years. It's a 20-year decreasing term policy. That's often referred to as mortgage insurance. It really isn't. It's just a name. It's a sales name that organizations use. Okay?
Right.
And it's not generally the best kind of insurance because it runs out. You see, look, here's the point. How many people do you know that are over age 75?
Quite a few.
Okay? And I know we have many of them at our workshops. If you buy decreasing term insurance or 5-year, 10-year, 15-year renewable term insurance, most of those policies run out at age 75.
Right. Oh, I see.
So if you live beyond 75 and you don't have a permanent kind of a life insurance policy, you don't have any insurance and you can't buy any, probably.
Right.
Or if you could get it, it's excruciatingly expensive. So you got a big problem here. And when banks and organizations that grant mortgages will sell group insurance to insure the mortgage, it's generally not the best insurance to have.
Right.
Because it's got restrictions built into it. Everybody should have their own policy. For example, I worked for a company one time where I had $1 million group policy with the company I worked for.
Right.
And they decided to replace their whole group insurance plan.
Right.
And all of a sudden I got $250 instead of $1 million.
Right. Yeah.
I mean, that messed up my personal financial plan because I had to apply for another $750,000 worth of personal term insurance to cover the shortfall.
Yeah. Well, what I understand, and you correct me if I'm wrong, for mortgage insurance, then you have to die in order to collect. Whereas on the mortgage debt insurance, I understand, is that it just keeps going until your mortgage is paid off.
Well,
is that correct, or?
No, you have to program the insurance to fit right along with the mortgage balance on the insurance, or on the mortgage. Let's say the mortgage is a 20-year decreasing mortgage, which means it's amortized over 20 years. The mortgage runs out in 20 years.
Right.
You could buy a 20-year decreasing term policy that will match that mortgage.
Yes.
That's generally what happens.
Yes.
There's no cash value.
Yeah.
The only way you have cash value inside an insurance policy is if the normal premium is $100 a month, but you pay $130 a month. $30 goes into a savings plan that's attached to the policy.
Right.
You pay for it one way or another.
Yeah. Yeah.
And frankly, I'm not a great in limited cases, maybe. But generally speaking, I don't think cash value insurance is the best kind of insurance to have.
Okay. Okay. Thanks very much. That clarifies.
But the best thing to do if you have questions, or anybody out there questions regarding your insurance, the best thing to do is call Frida, make an appointment, come in, and we'll sit down and have a discussion about it.
Okay, that's good advice. Thank you.
Thanks, Alan. You take care. Enjoy the weekend. Appreciate the call.
To you.
And I'll look seriously at getting those workshops going again.
Yeah, get your fishing tackle.
And get all my hooks nice and sharp.
Yeah, make sure that they're not rusty.
Okay, take care. Okay, Alan's line is now open, so if you've just joined us once again, I'm certified financial planner Fred Snyder, also registered financial planner representing Scotia McLeod, and we have another Alan from Vancouver on the line. So, Alan, welcome to the program. Hello, Alan.
Good morning, Fred.
Good morning, Alan. How are you?
I'm doing well. It's an amazing day out there.
It is. It really is. Gorgeous.
And I'm just about to get out on my bike and do a ride to the Vancouver flea market.
Okay. Wow. How about that?
Where I'm going to pick up a 1930s Gruen Curvex watch that I've had a watchmaker there who has a stall there and who has just done a complete reno and cleaning and lubrication for me.
Wow, that's great. Fantastic.
Now, I would like to put in another plus for you returning to the creation of new workshops. I'd like to put in put my bid in for that.
Well, actually, let me encourage all the listeners who are disappointed that I'm not doing a workshop. I started a project a couple of weeks ago where my project is going to involve putting together 50 case studies.
Wow.
50 case studies, and that's going to be my workshops going forward.
Okay.
I want to do those case studies because I think they're more reality than just the overall general brush that we do. Okay, like Angela's given me a document here, and she's got a kind of a guide to go by, and she's got scenario 1. Adam is 35, suffered a delayed diagnosis to compartment syndrome to his leg, which has left him with chronic pain in a drop foot. Okay, well, this is like a case study. It's the same idea. Okay, I had a woman come into my office. She had an awful lot of money with Phillips Hager North, all with one company, which is Phillips Hager North is owned by RBC, as we know. But she doesn't have all her eggs. She's got all of her eggs in one basket. It's all with one company. And the risk, as opposed to what I would recommend as a replacement, her risk is on a scale of 1 to 10, 1 less with me than it is with what she's got. Her rate of return is 2.4% compounded annually better. Less risk, greater return. Isn't that what everybody wants? Less risk, greater return? Okay? And if you extrapolate that and you push those numbers into the future, if she stays where she is, she'll have between $320,000 and $400,000 less money if she stays there than she would have with me. And in 10 years, it's over $1 million difference.
You know, Fred, this is, something I'd like to mention, and I think that probably there might be a great percentage or some percentage of your callers out there, or listeners, I should say, that would be in the same position similar to say that I am. I am self-employed. I was dealing with quite a bit of credit card debt, which I have just within the last 2 years have been able to reduce by literally $25,000. And that was pretty extraordinary. In fact, I can't even hardly believe it myself. So I am just at the point now, and I'm also happen to be a senior citizen as well, where I could start looking at actually being able to start to pay myself.
Okay, well, that's good news.
And I've been coming to your workshops over a 1.5 year period, and I realize that there are a lot of people out there, obviously, that do have money and are able to, to invest, and they've got properties, et cetera. But then there is also this other portion of the population that are like me, and I'm sure that there are also a lot of younger people coming up that are in a similar kind of position where they are working in a freelance occupation, or and they need your assistance and your advice as well. And I think it would be very interesting to be reaching out not only to people in my position, but also people that are younger. as well. And that's just something that I just want to toss out, on the airwaves.
Well, I'm making great progress on my case studies right now. So I finished another one yesterday. So I can do about one a day. So I think maybe when I get to number 25, I'll start the workshops up again. How's that?
Well, no, that sounds fantastic. And what I'm saying is, mentioning also is, it would be interesting for you to do, even a Sunday program that would reach out to, let's say, 20-somethings, 30-somethings.
Well, you know something, I keep saying this over and over again. There's lots of people that come into my workshops. There's lots of people that call this a radio show. I have many conversations all the time with people, and they say, well, I don't need that. I already have it. But how about your kids? How about your next-door neighbor? How about your friends and other relatives? Everybody needs financial planning. I'm fortunate that I look at financial profiles all the time. I see 4 people almost every day. Okay? And every situation is different. I look at your net worth. I look at your cash flow. I look at your financial problems, goals, and objectives, your insurance, and all the rest of that kind of stuff. I see those profiles all the time. I see some people that are really wealthy. I see some people that aren't. They're very poor, and they're struggling. Every situation is different, but I have an opportunity to see that. And I can ask a question and almost know the answer before I get it. Like for example, here's a question for you. How much do you spend a month on groceries?
Oh, my. I'd say probably in the neighborhood of $300 to $500.
Okay. Are you feeding somebody other than yourself?
No, I'm not.
The average adult, according to Stats Canada, spends $350 a month on groceries. So you were just about bang on.
And I also am someone who loves to cook, but also and I cook everything from scratch. And I try to cook, I cook using ancient grains such as quinoa, organic brown rice. I do make all my own sauces, etc. So I don't buy a lot of the prepackaged, preservative embedded type foods, right?
So what advice would you give our listeners, Alan, as to how they can do better financially?
How they could do better financially?
Yeah.
Well,
how can our listeners do better financially?
Well, boy, that's
what this show is all about.
That's an interesting question. I would say one of the things would be to definitely think twice about using their credit cards. That's for sure. I went for almost 2.5 years where I basically stopped using credit cards entirely and went back to a cash situation. And I would only buy something.
Alan, isn't it amazing how much easier it is to use our credit card than it is to use the real stuff, cash? Somehow there's a psychological space between them.
Psychological thing there, I'm sure.
I opened up my wallet and I got a bunch of credit cards and I got a bunch of $100 bills. I hang on to those $100 bills like crazy, and I don't mind flashing the credit cards all over the place. And somehow it's different. It isn't different.
Well, listen, I mentioned something else. I now have 4 new credit cards. And this is a crazy thing. I mean, I basically don't use them all, but they were offered to me, even though I was in a situation where I had, credit cards in collection, that over the last 2.5 years.
You had credit cards in collection, and they actually offered you more credit cards?
No,
okay, that's crazy.
I turned around and I settled all of those cards, which obviously meant that I was able to sell them for a percentage on the dollar, as opposed to what was actually owed, because I would have never been able to pay what was actually owed.
Alan, okay, yes. Really appreciate your input. We do have to move along.
I understand.
Okay.
I understand.
I really appreciate your call. And again, if you want to take this to the next level, give Frida a call. You can reach Frida, anybody else out there as well, 604-737-3512.
I'm going to do that.
You take care, Alan. Appreciate the call.
Bye.
Enjoy the weekend. Alan's line is now open. So once again, ladies and gentlemen, if you just joined us, I'm certified financial planner Fred Snyder, also registered financial planner. I'm here with Angela Price Stevenson. Stevens, I should say, who represents Murphy Batista, and she's a lawyer. We're talking about the legal end of financial planning, the legal side of financial planning, and we're talking about some scenarios. So let's just talk a bit here about this guy Adam. Okay, so let's say this is a case study, that you have. So here's Adam. He's 35, suffered a delayed diagnosis to compartment
It's
syndrome.
a delayed diagnosis of compartment syndrome to his lower leg, which left him with chronic pain and a drop foot. Basically, what that meant was he had suffered an initial injury, and then he was poorly treated by the doctors and the nurses at the hospital where he went to receive treatment, and there was a delayed diagnosis of this particular concern, which meant that he had a lot of necrotic muscle that had to be removed. That's left him with chronic pain and quite a significant disability. And I mean, the names have been changed and many of the details have been removed, obviously for anonymity. But Adam, as we're calling him, he had really no more than a high school education. He was a foreman on a construction site earning around $60,000 a year before the injury. He's married to a gorgeous wife with 2 young children, 5 and 8. And although he does have some earning capacity still, it is undoubtedly that he will be earning considerably less as a result of the injury, and it's likely, highly likely, that he will retire before the age of 50 just because of the chronic pain. It's so wearing. Adam, at the time of the injury, had no savings, no investments. His home was around $320,000 in value, and at the time of settlement he had a balance of around about $180,000. And after several years of litigation, we managed a settlement, and he received approximately $800,000 in compensation. And one of the very common questions that I have from clients in this situation is, what should they do with that money? Well, I'm a lawyer, I'm not a financial advisor, and so the bottom line is go seek financial help.
Get a financial plan.
Absolutely, yes, I agree entirely. But often, even in the mediation situation, when anxiety is running high and they think, well, is that enough? Is that enough? What can I do with it? Often one of the questions is, well, should I pay off the mortgage immediately? And that's something that's usually kind of bounced around because of the anxiety of if they settle at this sum, what are they going to do? Now, for me, as a lawyer advising them, it's not what they should do with the money. It's, is this a good settlement based on the scenario, based on the facts and the risks? Is 800 the right level to settle at? And in this case, it was. In fact, it was a good settlement given the fact that he had quite a significant work capacity still left within him. But often, clients say, well, should I pay off my mortgage? And that's something I hoped you could shed some light on.
Based on the information I'm looking at here right now, still don't have enough information to be able to give you, like, $800,000 will provide an income of about $40,000 a year. Mm-hmm. If he reduces the $800,000 to pay off the mortgage, then the income will be less.
Yes.
So you got to look at income, you got to look at expenses, and you got to look at all those things.
I see.
A lot depends on what kind of a mortgage it is. Maybe you'd be better off to have a line of credit. Maybe a reverse mortgage might be a good idea for this fellow.
Yes.
There's a lot of different options. But you see, the bottom line is, how can he organize his finances, his income, his expenses, his assets, and his liabilities? What's the best way for him to do that in a way that provides him with the best cash flow? The bottom line is, how much income does he have at the end of every month to spend? Doesn't matter how much he owes or doesn't owe or anything else. What's left over at the end of every month? How do you organize things so you have a very positive cash flow?
I see. So it really is a case of each individual needs to come and receive financial
without a doubt,
advice.
because look, I could write a book and say, look, if you got $800,000, the best thing to do with it is pay off your mortgage.
Yes.
Be
a very short book.
It would be. So the bottom line is, maybe not. Need to talk to him. He's a young man. He's not that old, but his capacity to work. Did you say he's able to go back to work now?
He is able to do some work, certainly. He's somewhat limited, and that's likely to be reflected in his income moving forward. But yes, he has work capacity.
Okay, so the bottom line is maybe he should pay off his mortgage. You got to remember, paying off that mortgage is almost like getting a guaranteed return. Okay, because let's say his mortgage is 4%. He pays that off, he's getting a guaranteed return of 4%. That's the essence of it. Okay?
I see.
So if he were to invest that $800,000, could he get 10%?
Mm-hmm.
That's the other part of that equation.
Right.
Okay, let's talk about scenario no, we have to go to the break, right? Okay, so we have to take a break, and when we come back, we'll continue talking about some case studies. Don't go away.
Fred Snyder.
I want people to call the show that are genuinely interested in increasing their financial IQ so that they can become financially independent sooner and stay financially independent longer.
Fred Snyder.
You don't have a blueprint. Imagine trying to build a house without a blueprint. And how about having a blueprint for your life? What are your lifestyle goals? You need to think about your family life. What are your goals about your family life? What are your lifestyle goals when it comes to health? What are your lifestyle goals when it comes to finances, mental and spiritual? You have to set goals in all those areas, not just finances.
Fred Snyder.
Often we fail because we put too much emphasis on one area and ignore everything else. We work our butts off and we ruin our health. So life is all about balance. So you need a life plan.
Fred Snyder.
Napoleon Hill says this, wrote the book Think and Grow Rich. Anything that you can vividly imagine, ardently desire, and enthusiastically act upon will inevitably come to pass.
Fred Snyder.
My goal, my mission is to help people enhance their financial IQs by teaching them what they need to know to make better financial decisions.
Fred Snyder. Sunday mornings at 9 on AM 650. This is CISL Vancouver. All-time favorites. AM 650. Welcome back to It's Your Money on AM 650. If you have a question for Fred, call 604-280-0650. Now, back to Fred.
Okay, we're back. We're live. Remind you once again, ladies and gentlemen, and listeners out there, this is a live show. We like to have conversations with you about your money and how to keep it. How to keep it is the key phrase in there. We all earn a small fortune. We just don't keep it. Ask yourself this question. How long have I worked? How much money have I made? How much of that do I have left today? And am I happy with the answers? And the chances are you're not. Take 100 people started equal today at the age of 25. By the time they're 65, 1 is wealthy, 4 are well-to-do, 5 are still working, 36 are dead, and the remaining 54 are dead broke, dependent on family and state. The stats are not in your favor, okay? You got to think about the fact that somewhere between 5 and 10 people achieve any measure of financial independence. That's less than 10% by the time they're 65. And by the time, if they live to age 70, by the time they're 70, half of those people are financially dependent because they didn't deal with taxes and inflation. And generally speaking, people fail because they do not have the knowledge. I think knowledge is the key. The more you know, the better off you are. Someone once said you walk a mile and then you can see further. Well, I think knowledge feeds on itself. Interest breeds interest. So you got to become proactive with how you deal with your money. That's what we're talking about. So again, I'm talking here with Angela Price Stevens, who represents Murphy Batista. She's a lawyer. We're talking about some case studies. Tell us about Brian.
Oh, well, Fred, again, we've changed the name and removed some of the details that might identify him. But Brian was probably one of my more significant cases. He was 42, he's not married, no children. He was an operator of a giant excavating machinery in an open mine up north in BC. He was earning around $70,000 a year. Brian injured his neck, and over the years it became apparent he required some surgery. And while he was on the operating table receiving that surgery, he suffered a catastrophic brain injury caused by the anesthesiologist just failing to respond to some very significant declining vital signs. This starved Brian's brain of oxygen. Very sad case. It left him totally incapable of looking after himself. He requires 24-hour care. He's not competent to manage his own affairs, and I helped him appoint a committee comprising family members. Now, after 3 to 4 years of litigation, we secured an excellent settlement for him. It was best part of $7 million. Now, Brian has a near normal life expectancy. There, you can imagine there were a range of expert opinions on this, from 69 years to 84. But at the end of the day, he had a normal life expectancy. And obviously, this individual needs to have the money invested to last him his lifetime. And where would you start with this, Fred?
Well, you got to start looking at the options. He's got enough money that's going to provide him with substantial income, probably more than he needs. But you want it to be guaranteed for life. So he could take that money. He could buy himself a pension, essentially. A GLWB product gives him a guaranteed income for life, which would be substantial and very, very tax efficient. That's again, but the answer, to your question is much like the first one. There's not enough detail to be able to really give highly specific answers, but you need to explore the possibilities. A good investment portfolio. I have 10 model investment portfolios. The worst return of the 10 is 6% with extremely low risk. So if you invested $7 million and got 6%, he's going to be pretty well off. He's going to have a pretty handsome income without even touching principal. So again, you have to sit down and you got to talk to people about their individual circumstances. You got to look at their tolerance for risk and all those other things. His investment knowledge, his family's investment knowledge, because they're obviously managing his affairs. So you got to look at all that. Some kind of a trust might not be a bad idea. There's different ways to do this. I don't know if you can tell me, how was this funded? Is there a program in place to cover it right now? Did the money go into a trust, or how did it get set up?
Well, actually, once I've secured the settlement, I always make sure that the family are well equipped to choose an independent financial advisor, because clearly I'm not qualified to give that advice.
Sure.
So we ensure that a sum of that size goes directly into a financial institution. It doesn't go to a private individual as such. But one of the questions that is often asked in this type of situation, because Brian, in this scenario it's Brian, but it could be a number of my other clients, they didn't have a will prior to their catastrophic injury, and then following their injury they do not have testamentary capacity, so which basically means they can no longer
Can't make a will.
They can't make a will. Now, life expectancy is often something that's highly contested during the course of the litigation. I mean, I could pop my clogs tomorrow. We just don't know.
Nobody knows.
Nobody knows. So one of the questions that's often asked by the family members is, how can we ensure that this lump sum goes to the family, as opposed to is lost to the government afterwards, when we don't have somebody who's able to make a will? I'm assuming that there must be types of investment that fall to the family, or you can designate certain beneficiaries.
Well, there's trusts, and you can name beneficiaries of the trust.
Yes.
You could take the money and you could buy what's called a segregated mutual fund from a life insurance company.
I see.
With a segregated mutual fund from a life insurance company, you can name a beneficiary.
I see, yes.
So the money then would pass to the beneficiary, and it bypasses probate, so there's no probate fees, okay,
Right.
that you need to deal with. Again, there's dozens of options. They all have to be weighed and assessed. That's the bottom line. And you need to deal with somebody that's fully licensed, that's licensed to handle securities and life insurance, and that understands enough about the legal side of things that you can kind of integrate it all together.
I see.
Again, everything that we're talking about, though, really starts with a written financial plan. That's first base. Can't get to second base until you have a written financial plan. You got to sit down, talk to a financial advisor, and say, make a plan for me. And if you're uncertain about that plan, then you get a second opinion from somebody else.
Yes, I mean, in fact, it's quite typical that I would, when dealing with such a large sum of money, I would be encouraging a client to shop around and to feel comfortable. You need to feel comfortable with whoever you're dealing with, because we hope this will be a long-term relationship. So, as somebody as knowledgeable and personable as you, that's exactly the kind of person that I'm looking to hook them up with.
It can't happen without trust. I think what a financial advisor needs to do first is earn trust.
Yes.
That's your bottom line. Now, Scenario 3, you got a question here. What is the hottest investment around if a client injured in, say, a car accident, received $50,000, didn't need to use it for therapy or other immediate requirements? What is the hottest investment? Again, it's a tough question to answer, but my favorite investment fund right now is RBC Canadian Equity Income Fund. The return on that fund over the last 5 years is pretty close to 25% compounded annually.
Wow, that is significant. And is that available for a sum of money as low as 50,000?
Yes.
I mean, 50,000 is significant, don't get me wrong.
The answer to your question is yes.
Wow.
The return on this fund in the last 3 months, the last month is 2.9% or something like that. This fund is it's a first quartile fund consistently. The MER is extremely low. It's managed by a lady by the name of Jennifer McClelland. It's an equity, it's a Canadian equity fund that pays high dividends. The dividends are almost 5%. It's not guaranteed, though.
Of course, nothing in life is guaranteed.
Okay. So, but so you're asking me what hottest fund? That's one. Another one is a fund called Dynamic Global Infrastructure Fund. This fund invests in all the companies that we will be rebuilding the bridges and the highways of North America, really even global. So they'll be busy for a decade doing that, maybe 2 decades.
Right.
So those companies are all going to do well. That fund has really good numbers as well. I think the 5-year compound rate on that fund is 18%, but it's getting better.
Right.
There's nothing wrong with 18%.
No, not at all. What kind of risk that comes along with the 2 examples that you've given?
The risk on both of those funds is about moderate. Slightly, maybe a tad more than moderate, but not much.
I see.
Okay, as measured by standard deviation, it's about 10.5, 11.
I see.
10 is moderate as measured by standard deviation. So it's not high. The next thing you ask is, what is the Smith maneuver? Who can take advantage of it?
Yes.
Love your questions. Okay. The Smith maneuver is a way to make your mortgage interest, or any interest, not just your mortgage, interest on your credit card, your mortgage, or anything else tax deductible. A guy by the name of Fraser Smith wrote this book and explains it extremely well in the book. Anybody wants to call my office, I'll be happy to provide them with the book.
Fred, I was up till 2 a.m. trying to get through that book before today's show. It's actually very interesting. And you're right, I will be reading it 2 or 3 times.
Well, I basically, I believe, I've talked about all the reasons why people fail financially, but I think a fundamental reason, it really gets down into the nitty-gritty, is they don't know how to manage debt. They get in debt. They spend more than they earn. That leads to debt. They don't know how to manage the debt. I think the trick is to learn how to manage debt. And one of the key things is if you're going to pay, if you're going to buy something and you have to finance it, if it's personal, pay cash for it. If it relates to business, put it on your credit card, because then the interest is deductible. Don't do it the other way around. Because if you do it the other way around, now you got to use the Smith maneuver to undo it.
I see. Right.
Now, you're a lawyer, and there's a lawyer by the name of John Singleton. And it's called, some people affectionately refer to this as the Singleton Shuffle. But quite a few years ago, a lawyer here in Vancouver by the name of John Singleton decided he wanted to buy a house. And I guess houses then were a lot less expensive than they are today. He needed $300,000. So he went to his firm and he said, look, I need to temporarily take $300,000 out of our float account. Would that be okay? And they said, of course. So he took $300,000 out. He bought the house. He paid cash for the house. It was only $300,000 back then, so you know how long ago that was. Okay, so he paid cash for the house. Now he's got a house free and clear. Then he put a mortgage on the house for $300,000. He's got $300,000 back in his pocket now, and he put the $300,000 back into the business. Claimed it was for business purposes and started writing the interest off. Under general anti-avoidance rules, he was challenged by Revenue Canada, and he went to court, and he won. So there's legal precedent on this one. And there's been a number of cases since, and every time the taxpayer won, except in the last case, and that was called the Lipton case. In the case of Lipton, Lipton lost. But even the presiding judge says that had Lipton done it right, it would have worked.
So may I ask, what did Lipton do wrong?
Well, he tried to use the all kinds of rules. He was moving money in and out of one company into another one. He got involved in implications, involving the fact that interest expense. If I loan money, we'll say if I loan money to my wife, and it's an interest-free loan, and she buys a GIC with that, the interest on that GIC is still taxable in my hands.
I see.
He tried to get around that particular concept.
I see.
Okay.
And could I ask, did John Singleton, did he intend or did he ever actually live in that house? Because that would have made it his private residence.
Well, I think he did,
Oh.
but I don't know for sure.
Right.
But I imagine he did. Yeah. You see, you don't have to live in a house even for it to be your principal residence. I can have a place at Whistler and a place here. I may not live in the place at Whistler. I can still deem Whistler to be my principal residence.
I see. You deem it to be rather than by conduct.
Yeah.
That's interesting.
These are all very, very interesting concepts. So if you're out there and you're listening to the show, we're talking about financial planning, and we're talking about how do you get out of the hole? You stop digging. Okay, I guess that's the bottom line. And that brings up the issue of budgeting. Now, I'm going to say this hard and fast. Budgeting. You got to have a budget. Okay? Now, I know there's a lot of people listening to this show right now that don't have a budget. And I'm going to say to you, if you don't have a budget, your money is managing you. You're not managing your money. And financial planning, a good financial plan, starts with a proper budget. Forget everything else. Forget everything else I've said. You want to do better? Have a budget. The key to success is not to spend 100% of what you earn. Spend less than you earn. And there isn't anybody that's listening to me right now that can't do that. You know something? I've had people say to me, you know, you're right. I know I should be putting away $500 a month. I know it. But you know something? Can't do it just yet. I'm getting a raise next month. I'll do it when I get the raise. Or I'll do it when Johnny graduates from college. Or I'll do it when I get the car paid off. I'll do it when I get around to it. I'll do it sometime in the future. I'll do it tomorrow. They're procrastinating. Okay? I've never had anybody ever tell me this, though. You know, I've decided to take up smoking, but I can't afford to do it just yet. The cigarettes are too expensive. I mean, they cost $1 a day, but I got to earn $2, pay $1 of tax to have, $10 a day. I got to earn $20, pay $10 of tax to have $10 left to buy those cigarettes. Okay? Now, if I could quit smoking, I could save $20 a day. Into my RS, that's $600 a month. And I've seen people who are in dire poverty. They somehow find the money for cigarettes. And I say, if you want to enough, if you're proactive enough, you can find the money you need to pay yourself first and to be able to save on a systematic basis. So if you can't save, quit smoking. Quit spending a small fortune on lunch. Brown bag your lunch to work. Quit going to Starbucks. Okay? Find a way. List everything you spend money on and take $10 off of every item. By the time you get to the bottom of the page, you got $200 or $300 that you can put away. Start in a small way if you like, but start. Start that habit, because a good habit is just as difficult to break as a bad one. You smoke, you can't quit. Okay? Form the habit of saving money systematically to the point where you can't quit doing that either. Because I have elderly people that are in their 80s and 90s that still save money systematically. For what reason? They can't take it with them. Okay? They need to de-invest, not in the accumulation process. So that's what we're talking about. We're talking about the fact that a budget is the heart of a financial plan. And most people don't have a budget. Obama, U.S. government didn't have a budget, and I don't even know if they got one yet. They're running without a budget, and the U.S. government is $17 trillion in the hole. And that doesn't count future unfunded liabilities. When you add in the Social Security liabilities and everything else, it's like $54 trillion. It's scary, okay? But one good thing about the whole thing, in a way, is that the U.S. can print money. Europe can't. So they still have an awesome economy, and I don't think they're going to go down the tube. They have the power to tax. I think the greatest marginal tax rate in the Second World War was 90%, something like that. So they can kick taxes way up through the roof on the very, very rich people.
Yeah.
If they have to. But the secret is to have a budget.
Well, my concern for myself right now is that I have 2 teenage children. The elder of the 2 is likely to go off to university in the next 15-18 months, and what I would like to do, if I haven't left it too late, is really to instill within them the need to budget as they fly the nest and make their own decisions. And they've had a very they've had a good upbringing, and perhaps I've sheltered them too much from the financial realities. That's my concern at this moment. So perhaps I should share some financial realities with them and get them to involve themselves on what are we going to spend this month. Can't have it all.
And the same is true of all parents.
Yes, I think so, yes.
Okay.
Yes.
Get your kids on a budget. You can't spend more than you earn without getting into trouble. You're going to hit the wall if you do that. Sooner or later, it comes to an end. All of a sudden, you can't borrow any more money. Your deficit is huge. Your income stops. You get sick and you can't work. All these things happen, and all of a sudden the well runs dry and you hit the wall. What do you do now? Okay? And you do it while you're young enough that it makes a difference. If you wait until it's too late, it's not a good plan. I remember one time, many years ago, I sat at the kitchen table and I had a boarder. His name was Dowd. But this guy called me up, he knew me, and he said, I want to come over. I have an appointment with your room and boarder, Mr. Dowd, and I'm selling the Canadian Gas and Energy Mutual Fund. So he sat at the kitchen table and he put on a presentation for $20 a month with this guy. And at the end of the day, beautiful presentation. At the end of the day, he said, well, what do you think? He said, well, I'll think about it. I looked at him, I said, I'll take one. He wasn't even giving me the presentation. I said, are you telling me that if I put away $20 a month into this thing, I'm going to have $20,000 down the road? I think it was 10 years later or something based on past performance. He said, yeah. I didn't know that. And I think I was about 33 years of age then. Why didn't I learn that in school? I once did this calculation. My first car was a 48 Chevrolet. Cost me $600 a month, or $600, $50 a month for a year, Bank of Montreal. I drove it for 6 months. Had to have a brand new car. Traded on a 55 Plymouth. 1 year later. That was in 1955. Brand new 55 Plymouth. I was 18. I calculated one day, let's suppose I had driven the 48 Chev for another 2 years and not bought the 55 Plymouth and invested the money instead. How much money would I have today? The figure is $2.8 million. And I use Templeton Growth Fund as a model, which is average about 14%. Now, again, I'm not suggesting that's going to happen again, but that's what would have happened, and that's the year Templeton Growth Fund started. And that's the power of time and compounding. So how much did that brand new car cost me? $2.5 million, we'll say. We have to go. So, Angela, thanks for joining us.
Thank you very much. That was very interesting and quite motivating, I have to say.
Okay, we're out of here. Same time, same station next week. Bye for now.
If you'd like Fred to review your portfolio, call his office right now at 604-737-3512. That's 604-737-3512.